All right, so if you're running a business, you're constantly buying stuff, equipment, vehicles, maybe even buildings. But have you ever stopped to think about what those assets really cost you over their lifetime? It's way more than just the initial price tag. Today, we're going to pull back the curtain on depreciation, a core accounting concept that tells the true financial story of everything you own.
You see, to really get a grip on the cost, we have to think bigger. We need to think about something called life cycle costing. It basically means you track every single cost an asset racks up, from the day you buy it to the day you finally get rid of it. That initial price, that's just chapter 1 of a much, much longer book.
So that's the million-dollar question, isn't it? If an asset has this whole life story full of costs, how in the world do you show that on your financial reports? How do you account for the value it loses every single time you use it?
Well, it all comes down to looking at that entire life cycle. And trust me, this isn't just some accounting trick. It's a brilliant strategic move that gives businesses a complete, long-term picture of what their assets are truly costing them, from cradle to grave.
So what does that life cycle even look like? Well, it starts way before you even get your hands on the asset. There are costs in planning and designing, then buying and installing it, and it doesn't stop there. You've got ongoing operation and maintenance costs, repairs, maybe even major overhauls or replacements, and then finally the cost to dispose of it. Every single stage hits your wallet. And this right here, this is such a classic business mistake. Just looking at that initial purchase price, what we call CapEx, is like only seeing the very tip of the iceberg. The real story and the real financial pain is often hidden below the surface in those long-term operating costs, or OpEx. If you ignore those, you could be sailing straight for a cash flow disaster.
Okay, so we know an asset loses value and costs us money over its life. How do we track all that wear and tear on the books? Well, this is where our star player for today steps onto the field: depreciation.
So what exactly is it? Well, put simply, depreciation is the accounting method for spreading out the cost of a physical asset. Things you can actually touch, like machinery, buildings, or vehicles. Now, it has a cousin called amortization, which does the exact same job, but for non-physical or intangible assets, things like patents and software. Okay, now lean in because this is where it gets really, really interesting. This is a key takeaway. Depreciation shows up on your income statement as an expense, which means it lowers your taxable profit. But, and this is the magic part, no cash actually leaves your bank account. It's a non-cash expense. It gives you a fantastic tax break while letting you hold on to your cash. It's one of the most powerful strategic tools in all of accounting.
Of course, knowing what it is isn't quite enough. We need to know how it's actually done. And here's the thing, there isn't just one way to do it. So how do businesses pick the right method that actually reflects how their assets are being used in the real world?
Let's start with the most popular kid in the school, the one you'll see most often. I like to call it depreciation by the clock. Its official name is the straight line method, and you guessed it, it's all about the steady passage of time.
The logic here is actually beautifully simple. Let's walk through it. First, you start with what the asset cost you. Then you take a guess at what it'll be worth at the very end of its life. We call that the salvage value. The difference between those two numbers is your depreciable cost, and you just divide that by how many years you think you'll use it. Easy.
So let's just hammer those key terms home one more time. The asset cost is what you paid for it. The useful life is your best guess for how long it's going to last. Salvage value is its estimated scrap value at the end. And the depreciable cost is the total amount of value you're going to expense over its lifetime.
And what's the end result of all this? A neat, tidy, and completely predictable expense that is the exact same amount year after year after year. It's consistent, it's simple, and it's perfect for assets that lose their value nice and evenly over time.
But what if an asset doesn't lose value just because another year has gone by? What if its value is tied directly to how much work it actually does? For that, we've got another tool in the toolbox: depreciation by the job, or as the accountants call it, the units of production method.
This method is absolutely perfect for machinery or equipment where the wear and tear is all about usage. Think about a car's value being tied to its mileage, or a factory machine's value being based on how many widgets it spits out.
To really make this click, let's use a great real-world example. Imagine an equipment rental company just dropped $50,000 on a brand new skid steer loader. They figure at the end of its life they can probably sell it for about $5,000. So the total amount they need to depreciate, that depreciable cost, is that $50,000 price tag minus the $5,000 salvage value. That gives us a grand total of $45,000.
Okay, now here's the twist. Instead of dividing that number by years, we're going to divide it by how much work this machine is actually expected to do.
The company estimates that this skid steer has a total useful life of about 5,000 operating hours before it's ready for the scrap heap.
So you've got $45,000 of value, spread out over 5,000 hours of work. What does that shake out to per hour?
$9. That's it. That's our magic number. For every single hour that this skid steer is out on a job, rented and running, the business gets to record $9 of depreciation expense.
And this is where you really see the power of this method. Let's say in a slow first year, the machine only gets used for 600 hours. The depreciation is just over $5,000. But in a super busy second year, it runs for 1,200 hours, and boom, the expense doubles. The accounting expense perfectly mirrors the asset's real-world usage. It's fantastic.
So what we have here are two very different stories your accounting can tell. The straight-line method gives you that nice fixed expense which creates smooth, predictable profits. That's great for showing to investors. The units of production method gives you a variable expense that really reflects what's happening on the ground. But there's actually a third story, one that's all about tax strategy. For tax purposes, many businesses use accelerated methods, which front-load the expense into the early years. Why would they do that? Simple. A bigger deduction up front means a lower tax bill right now. That means more cash in your pocket today to reinvest back into the business. It's a powerful cash flow move.
And that really leaves us with a final thought. Choosing a depreciation method isn't just some boring accounting task, it's a huge strategic decision. It impacts your reported profits, your operational insights, and your tax bill. So you have to ask yourself, which story are you trying to tell? Is it one about the steady, predictable passage of time, or is it about the hard work actually being done?